All right, welcome back. My name is Chris Sachinelli. I get to build, buy, and sell simple profit businesses every single day. And today we're going to be covering a concept and topic that is very close to home, right? It's kind of foundational for us at Bootstrapper Capital. And it's oftentimes a question that we get, right? So we are in the business of buying businesses with Bootstrapper Capital. We ourselves are a micro private equity firm. We go out, we make offers, we buy deals, we build them up, and then we either portfolio package and hold them or sell them, right? Many times, folks are like, oh, that's really cool. Like, that's a cool concept. That's a cool idea. But like, how do you even do it? Like, what's this concept behind it? And when you say private equity, what do you even mean? So the goal of today's video is to get into the fundamentals of what it means to set up a private equity fund, right? We're not going to get into the details of like deal structures and like the intricacies of doing a deal. We're just going to talk like high level, like this concept of this industry, right? What is private equity? And if you stick with us to the end, we're also going to show you a way that you, as an individual investor, can also get started in this build, buy, sell game pretty simply in a pretty simple structure, right? The goal here is to hopefully accomplish this. We want to go through this, give you a good level of understanding so that you at least have enough knowledge and know-how that experientially in a conversation, you pick up the lingo, right? You're reading off the same sheet of music. It's a common vocabulary type of thing. And we want to do it in 30 minutes or less, hopefully, right? So that's going to be the challenge for today's video. This is a one shot, right? No editing, all the way through type of video. So private equity, what it really is it's the game of buying, building, and selling businesses, right? So private equity firms go out, they try to find and acquire companies. You're going to then try to build wedge equity in those businesses, which the wedge equity is just like the incremental value that's being created post acquisition, right? So buy low, build wedge, sell high, right? So you want to make the money in the middle, the money's in the wedge, right? And it's a structure, it's an industry. It's the idea of buying privately held companies, right? You're buying the equity of private companies. You're not going to public exchanges. I mean, you can go to a publicly traded company and take it private, but the whole game, the concept, and the industry in which we are in is buying private companies and then optimizing them, making them better, or figuring out how to make money off of these private entities, right? Buying and trading private entities. So you got a couple of people, like everything starts somewhere, right? Where do we start? At the beginning. The beginning is typically, a handful of folks will come together and they have maybe like industry knowledge, subject matter expertise, passion, right? There's a why, right? So there's a why in terms of why they want to get into this game of buying and selling businesses, right? They follow their why, they find each other, they share that why, there's a common connection. They're like, hey, let's do this thing. Right. So that's typically where it starts, is with a couple of folks that are passionate and have a purpose and hopefully some level of expertise to be able to then go out and execute on buying and selling companies. When they decide to do this, the next thing that they're going to do is formalize it, right? So they're going to want to formalize the relationship. And the way in which it formalizes is typically by setting up a general partnership in the form of a LLC, right? All of the things that we're about to go through today, asterisk, 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 clause, clause, clause. This is just like most common case scenarios, right? These are typically what it is. We do not live in a world of absolutes, right? So asterisk, asterisk, asterisk. I'm just going through like 20,000 foot experiential information in terms of like how this industry is coming together, just so you have the frameworks, like the general frameworks, right? So again, you could always do things differently. This is just like a common way to do it, just so that we can have a narrative, a story, and we can follow it, right? So these individuals are coming together. They're forming the GP, right? They're doing that because they want to do it through an entity, right? They want to operate this business through an entity, which then helps them limit the liabilities, like personal liabilities, as they're going through and doing deals, right? There's also tax advantages, right? This is definitely not, I am not a CPA or your accountant, right? And I'm also not a lawyer, so I'm also not telling you like legally how to do this stuff. This is all educational for those reasons, right? So take everything that I'm saying with a grain of salt. But there's a why. So typically they'll come together, they'll follow the why. And following the why, they're going to form the GP. Once you have the GP, now you have to do something with it, right? So now you have to follow that next why of like, let's go out and get into a vehicle that can start to do deals. So to be in a vehicle to start to do deals, you then set up another entity, right? And it's only going to get more and more complex as we work our way through. This is the simplest, this is the starting point. This is the simple process, right? So you got individuals that form a GP. The GP then sets up another entity, which is typically an LLC or a partnership, right? And that's for, again, a Y. And typically that Y follows around the tax advantage because it becomes a pass-through vehicle, right? Which allows you to reap and sow some of the benefits around the way in which the system is structured, right? Now you have a vehicle, but that vehicle can't really go anywhere because it doesn't have this thing called capital, right? So the whole concept here is you want to be able to go out and buy businesses. To buy businesses, you oftentimes need the capital to be able to do so. So this is simply like a vehicle, but now you need to take that vehicle and you need to fill it with something. That the thing that you're filling it with is limited partners, because the limited partners are bringing the cash, right? So you now need to go out and raise money into your fund. So now you're fundraising. So you're targeting typically high net worth individuals, accredited individuals, right, for certain regulatory reasons, right, into your fundraise. You're going out and you're pitching your investment thesis. You're pitching your why these folks came together in the first place, and you're pooling all of these individuals or entities, right, all of the folks that are giving you capital into this LP structure, and they are now called limited partners because you are the general partner. You're responsible for running the show in a sense, right? They are limited. They're passive. They're just providing capital. They're not providing operational expertise, right? So now you have, people that are interested, they're involved, you have capital. So now you have to follow the money, right? So now you have this flow of money type of structure that you need to be able to follow in the form of capital contributions. So the individuals that came together at first, they're going to contribute some capital. They're going to contribute capital to the GP. Typically, it's like 1% or so of whatever the total fund amount is, the value of the assets under management, somewhere around there. So there's some skin in the game, right? They're also going to cover all the legal setup and a lot of the other operational expenses and things of that nature to get things going. And then the rest of the money is coming from the LPs, right? So the GPs are contributing a little bit, the LPs are contributing most of it, right? And it's all getting fed and now funded into the fund, right? So now this fund has capital, right? The capital has been contributed, right? Now that you have capital in your fund, your next goal is to provide your primary focus and activity of operating your private equity fund, which is to go out and make investments into portfolio companies. And you're going to take the capital that's inside your fund. You're going to go find target companies that, typically you're going to be targeting, like typically sometimes, you want to make, investments into this thing called qualified small business stock corporations, QSBSC. That's why typically when you're doing investments or you're taking an investor on investment from investors, typically the requirement is that you're like a Delaware C Corp or something of the similar nature, because you want to be able to qualify for the QSBSC for tax benefits, right? Again, like not an accountant, but there's a why behind a lot of these things, right? And if you follow the money, you typically can find the why, because oftentimes the money is just following path of least resistance to how do you keep and retain as much as possible or make more, right? So the private equity fund, the GPs of this private equity fund are going out and finding and identifying investments that follow to the thesis around why the LPs gave the capital to the fund, and now they're allocating that capital into these investments, right? Once the investments are made, now they're portfolio companies. Now you're going through this process of building the wedge equity. You want to make these companies more valuable, right? Because you're in it for the long haul. There's a why behind it. Now you do your job and the companies are more valuable. Now there's more money. So the money, becomes profits, and those profits need to be split. So now you have a flow of money that you need to follow. And this is a big part of why folks structure, again, the entities and the formations the way in which they do. So typically it's like 20% of the profits, what we call carried interest, right? The profitable gains off of making these investments. Typically 20% goes to the general partnership as a fee for providing the service of operating the fund, right? Finding the investments, making the investments, allocating the capital, managing the portfolio, etc. And then the remainder of that typically will go to the limited partners. And then that's how they get their return on their investment from that carried interest. And again, that's also why you formed it the way in which you did, because there's specific types of tax advantages from the formation and the flow of capital, right? Not to make this overly complicated, but there is this thing in the private equity game called the waterfall, right? There's different types of waterfall structures, but really waterfall is just like following a waterfall, like the water flowing through a river down a waterfall. It's like a flow of capital, right? A flow of money. So typically it will be like the LPs will get the first profits out up until a certain point, and then after a preferred return or something of that nature, then it gets split up in this type of 80-20 type of structure. It's also important to note that this is just common. This is like what a common structure is. It's not always what the structure is, and you can always make it whatever it needs to be able to do the deals and get it done, right? On top of that, the carried interest, which for the most part, the big money is made in private equity on the carried interest, right? So the return of profits, the share, the profit split of, of carry, the profits off the deals. On top of carry, you also have this other thing called management fees. And the management fees are really kind of just like a keep the lights on type of fee, right? So the fund compensates the general partners for operating and making these good decisions and doing due diligence and managing the portfolio. So doing and executing on all the actions that go into ultimately, hopefully resulting in the profits that then get split. In exchange for executing on those things, typically there's a fixed management fee, which is more of a stabilized income stream for the GP, right? And typically that's from a percentage of the committed capital. So if it's 2% and you have a $100 million fund, that's $2 million a year that the GPs have in terms of management fees to be able to go out and do these things. And that's often going to paid on a quarterly basis. But again, that's all tied to the terms of however the structure is. And it declines, after investment periods ends, right? And that's why people are always perpetually trying to raise funds. And in fact, that's what we're going to be getting into kind of next. So once you have your first fund set up and things are really going pretty well, you want to go and you want to expand, right? Because like your management fees, you've already gone through all your capital allocations, like management fees are dwindling. Now all you have is carried interest to be able to come in, but you want to stabilize your income. So what do? You go and spin up another fund, right? And it's all fund stacking, right? So you're just repeating the process. You go through the process that we already did again. You launch another fund, and then you launch another fund. And that's how you go from building a GP to then building a franchise to then building a platform, right? And the folks that were originally a part of that initial team of folks that came together and set up the first fund, they then are at the management company. Now that management company is able to go out and set up relationships where they can bring on other individuals that want to launch their own little private equity funds. And that's like the franchise model, right? So the end goal here is to build enough of an infrastructure and to build enough of a brand and to have a really strong thesis and to have all the factors of production around being able to do this business, which would be like the ability to raise capital, the ability to get deal flow, the ability to execute on deals, the ability to stabilize, find and integrate, stabilize and optimize companies, the ability to return capital, right, at a good clip, right? The ability to attract great talent, right? All of those things go into building a franchise. And if you could build a franchise, you're doing pretty well, right? Because now you have multiple teams, multiple portfolio managers, and multiple funds, running and working at the same time. Now, that's pretty complicated, and there's a lot that goes into that. Everything starts somewhere. If you're looking at this and you're like, hey, like I want to get into the build, buy, sell game, the buy, build, sell game, but like I don't want to go through all of these things of like putting together a fund and going through all the fund structures that we just went through this video, but you want to get started, right? And you want to build up some expertise, some experience, some track record. There's another way of doing this as an individual, and that's through just like a simple holdco. So you could just simply go out, set up a little LLC, set it up as a holdco structure, and then just go out and start doing deals, right? And have everything kind of captured inside of your holding company. Do it in a very simple way. If you want to get a little bit more complicated, you could have an LLC up here that then sets up a C Corp, which could be that QSBSC right? So the qualified small business stock corporation, and then you're doing little acquisitions of other asset-based deals, and you're just rolling up into the one QSBSC. And like that's a really simple type of structure for pretty much anybody to be able to go out there and get into this game of build, buy, sell. Again, all of this was really high level. It was really just supposed to be an intro to the world of private equity. And we are constantly trying to put together more content, more material, and we want everybody to be able to support folks through just like a foundational knowledge in a sense, so that we can get into some experiential learning together of, how do you go out and do these types of things, the build, buy, sell. Hopefully this was enjoyable. If you enjoyed this content, please let us know in the comments below. If you want to watch other content, let us know suggestions. Definitely like and subscribe if you're willing to. We're trying to build up this channel. And until next time, I appreciate you watching it to the end of this video. Hopefully you get to get into the build, buy, sell game yourself.